Good morning. My name is Lynn Gillette. This is our workshop on AAII's Essential Investment Principles and Strategies. A couple of comments for those people in the room. Their restrooms are just out in the hall and down that direction. Haven't been able to do that for a long time. So it's our first in-person meeting for about 3 years. Anyway, just for those of you who are online, post your questions on chat. We'll monitor them and bring them up for the speaker to answer. And then for those that are in the room, I'll just give you a hand. You can ask a question in that way. We are very pleased to have Ray Rondeau here as our speaker and to have this workshop. We've been trying to do this for 4 years and finally have accomplished it. Let me just make a couple of comments about Ray and then we'll get going because we're a little bit late. Ray is production manager of AAI's Active Investing. He is a creator of the AAI Essential Investing video course, developer of the AAI Active Investor tools, and author of the AAI Computer Investing Classic Technical Indicator Series. He's been speaking for quite a long time to various groups. This program will be featured out of Silicon Valley, jointly with San Francisco and Eastern Michigan. And then he'll be speaking in LA and Sacramento. And it's a series that I had a number of people call me up and say, can't we do a live program with Ray? And we finally got there. Anyway, one other comment, Ray is going to be presenting at the Orlando Money Show, October 17th through 19th, 2024. So any of you who are lucky enough to be down there, that's available. I'm going to turn the time over to Ray and we'll start our program.
Okay, thank you. So it's been 3 years since you guys, or 4 years since you've done an event, and
Yes.
yeah, we had a few technical issues, so we're sorry about that. We also have a little bit issue with the video, but we will make it work somehow. I started 24 years ago. I always lead with a quote. I am way too old to change now. So I'm going to continue with the same. I have something blocking me here. Just give me a second. Lewis Carroll once stated, if you don't know where you're going, any road will get you there. The concept of having a strategy to get us not there, but where we want to go is really the focus of our presentation today. So welcome to all of you here, and of course, all of you in TV land out there. My name is Ray Rondeau. I've lectured, I believe this is my 26th AAI chapter, and Sacramento will be 27. That's coming up Tuesday. I've done them all more than once, except for one chapter. I did that one once. So thank you for inviting me. Took a while. I think I've been out here maybe 7 or 8 times. I've been in LA 3 times, San Diego 3 times. This is a highly visually based presentation. If you cannot read line 5 comfortably, please consider moving so you can do so, and this will not be an issue. Hopefully out there also that you should be able to hear me. If you can't, just give me a signal. And I do notice the people on the West Coast have an accent. I've only been here for a day, but so if I say car, I can't hear a car, I mean this right there, and I do not mean that, okay? I do not pronounce my R's, but we'll all be friends at the end of this, and I'm sure we'll understand each other. If you have not attended one of my events before, they're more educational or instructional, and they're focused on the active investor. In fact, AAI is going to be releasing a new area coming up called active investing. It's for more the hands-on traders or active investors. So we're excited about that. A big part of the material in this presentation is going to be that. In fact, almost everything I'm going to cover today is part of AAI's newest educational offering, AAI's Essential Investing course. You can see it here on the screen as promoted in the brochures. And we have them here for everybody who's in attendance in person anyway. One person in this room in person will win the course. It's valued at $399. And we're also going to give you local chapter funds, believe it or not. We're going to spend your treasury for anybody who passes the exam and gets certified with the course. So it's a way for AAI to give back and support our local chapters. I'm going to tell you a little bit about the course. You can see it in this video. The course currently has 17 classes and over 12 hours of material. The classes in the course are not simple recordings of a single instructor standing in front of a camera or the repackaging of a webinar like so many quote educational products out there. The classes are professionally produced, full-featured, interactive, we had a little glitch there, sorry guys. That video did not run, I apologize. The course is housed in a professional learning management system, the gold standard for online learning. It contains dozens of instructional videos, documents. It includes an exam, it includes certification, and then it also gives certification benefits for anybody who passes the exam. On this video, you can see it. In addition to the presentation videos, the learning materials, we give you preliminary learning materials like all the slides, PDF, key terms and definitions. And after completing the required minimum viewing percentage for each video, you can't just skip through it. We make sure that you do the entire class, you'll pass the test. When you pass the test, it'll give you a wealth of post-presentation resources on topics. It gives the words of wisdom benefit, complimentary premium benefits like books and services, bonus videos, you get a credit accrual, and you will also get your certificate of completion. And the EI course is not static. I just want you to know that. We're going to be releasing more classes as we go. We already have Marvin Appel recorded, fixed income expert Marty Fritzen, the youngest man ever elected to the Fixed Income Hall of Fame. Louis Navalier is doing a segment on stocks. So it's going to be ongoing. Another big benefit of the classes in the course is that the AI tools, which are a new set of tools that you have not seen before, they're all included, and they're free, and they're yours to keep forever. And that is a really big part of this. We give you a full year to complete the course, and include the 60-day money-back guarantee. And it really is an incredible course. We're kind of proud of it. And whether you believe this or not, it took us 5 years to work and complete this course to get it released. It's a long time. So we hope it benefits our members, and that's really our primary course. If you would like to get your free we're giving everybody a free VES class. All you have to do is go to this site, which you can't see because somebody has something up there, but it's called www.aai.com/AAII chapter event offer. And anybody can go here and get that free class. And you can also get a discount on the course, and I can tell you right now that the course will never be cheaper than the price that you see there. It's not going to be dropped. To win the free EI course, we're going to have a little fun, at least with the people here. Somewhere embedded in this presentation, you're going to see a graduation cap. I don't know what all this stuff is on my screen, but it's going to be really difficult for people in here because my screen is covered completely. There's going to be a graduation cap. If you see that graduation cap, okay, be the first to yell out, raise your hand, whatever, and you will get the free course. And the only way, just so you know, that we can allocate the funds to your chapter, so if you say, I want to do this, but I want to make sure some of the money goes to my local chapter to support it, you have to do it in the next day because it's the only way we know from what chapter you were. So just keep that in mind. Okay, let's get to the presentation. The 6 primary areas that we're going to be covering today. And we can take a break after about 55 minutes of the formal material. We can do a Q&A if you'd like, and we can also review the markets where I think the best opportunities are. One thing on this presentation was deliberately designed to be diverse. Okay, there's something for everyone, but probably not everything for someone, and there is a distance here. If there's a section that doesn't interest you, and there probably will be, just hang tight till we get to the next section. Okay, we're going to start with strategy, design, revelation. And the idea here is, how do we develop strategies? And we're going to start with the story. It's a true story, but the underlying concepts of the story are not novel. For years, I've been part of and oversaw an advanced group of traders that met up at MIT. We met every month up there. And as you can imagine, it was a competitive environment. And we like to encourage and challenge each other. About 20 years ago, it was a little bit longer, we had a graduating student propose a challenge to the group. We'll refer to him as Shane. We kind of changed his name a little to protect the innocent, but his name was Shane. And Shane was going to become a dad. And he wanted the following as for his son. He wanted to legacy $1 million to his son at his son's retirement. Keep that in mind. And he wanted to do it through investing, but he had no money to invest, which was interesting. He didn't want to use any additional work or effort. He didn't want to change his lifestyle in any way. And again, he didn't want to make any sacrifices. So now, obviously, Shane was being slightly facetious here. He had a desire to bequeath $1 million to his son with nothing to invest in, no effort. But it made for an interesting study, and subsequently, a lot of valuable lessons came from this. So after debates and deliberations, we kind of agree on this theoretical compromise. The first thing that we agree is we needed some money to start the investment process. So we looked at around $2.76 a day, or the price of 2 bottles of water, and that was another debate that was going on at the time. I have to get this thing out of the way. Okay. Now, please keep in mind, this is not a new concept. And I know we said that Shane didn't want to sacrifice anything, but at the end, you'll see that he does. So that's our proposal. So we proposed that Shane will invest $83 a month, only for the first 18 years of his son's life. How much money would Shane have to bequeath his son at that point? He puts down $1,000 a year for 18 years. How much do we think that Shane would have accumulated after 18 years? Well, we don't know, right? We're missing something. What are we missing? We are missing the average percentage return, and we need to know this. So in this table, we have some statistics on historical percentage returns of U.S. stocks in various asset classes from Paul Merriman, who does an excellent job doing a presentation in one of these classes. So we didn't take Paul's findings of 14.4% on small cap value. We just went with a nice round historical number of 11% for equities. With a long-term horizon of 70 years, this certainly seemed to make sense. So here's the question again. What do you think? How much money would Shane accumulate after investing $1,000 per year with a return of 11% after 18 years? But get ready to be disappointed, because it's not much, right? After the first 18 years, the final balance with $18,000 worth of contributions was only $53,000. Not very good, is it? But before you leave and head for the door, according to Shane's plan, he does not add another penny and he simply lets it ride. So now how much do you think that Shane would have to bequeath his son, presumably in a trust, when his son turns 70 for his retirement? What was the goal? The goal of $1 million? Well, the answer is over $12 million in today's value dollars. Keep that in mind. To Shane, at his son's retirement, all for sacrificing a couple of bottles of water in just for 18 years and just letting it ride. It's a difference maker that many people do for their grandchildren. They start this process up. Now, of course, this is purely hypothetical, right? We're assuming historical returns, which is all we have to base an assumption on, but we're leaving out some major factors here. Let's not kid ourselves. Commissions, they're becoming a thing of the past. Slippage is a real thing that we're going to address in the next section, how to deal with. And taxes, they're not minimum. And of course, though, Charles Grosblatt, who I'm sure you all know, he does have some advice on taxes. Inflation is going to significantly reduce this amount. We all would agree with that. That's the big one, but even there, we can use some investments to try to counter that to some degree. So after several months of meeting on this, there were several repeated lessons or revelations that seemed to come to the surface how to build long-term wealth through investing. And these were from the group's experience in their rather extensive research on the topic in strategy design. And we've estimated there was about 700 hours of combined knowledge from a really high-profile group of full-time investors, professional traders, and educators on trading and investing. So here in this section, we're going to take a look at a portion of what they thought were the most important elements to become a successful investor. And we're going to look at 15 of these. And you can get the rest of them in the course, but it's a good it's a good lesson. Number one, revelation number one, this is not going to surprise anybody. You got to have a plan, right? With a thorough, reasonable, and attainable plan, it was believed that investors would be more likely to achieve their goals and get to where they wanted to go. It seemed that successful investors had a plan, and with a plan, it reduced the tendency to act emotionally. And subsequently chase returns, buying high and liquidating investments and selling low. It was believed that investors who had a plan seemed to stay focused and in wise mind where they made better decisions. Revelation 2, an investor had to accept that variables and uncertainties in the market exist and that no plan is perfect. I agree, we do not know what the future historical stock market returns are going to be, right? But to design a strategy, we have to make some assumptions and projections with the best information we have. We need to control what we can and accept what we can't. And I think most would agree that having a plan that's not perfect, and seldom things are in life, is better than not having any plan at all, or worse, not investing at all, just because there's not a perfect way to do it. Number three, there is no single best plan or strategy for every person in every situation. The belief here is that an individual's ultimate approach and selected best trading strategies had to be based on and in line with their own personal situation. Some of these you can see listed here. And an investor also has to realize that these situations are going to change as their lifestyle changes. That makes sense. But put another way, the best way to invest in the right strategy is really the one that's right for you. I'm going to show you many strategies and approaches here, but not all of them are going to be right for every person in this room. Revelation 4, don't be afraid to think out of the box with alternate solutions. In Shane's case, everyone came up with different ways to invest and came up with different ways to accumulate the funds to invest. Part of the reason this challenge started was a debate over a bottle of water. And people at MIT will debate on anything, trust me, I know. They really will. I am trying to get this little screen out of my way, and I finally did. So what the group, most of the group figured, I'll just buy a $150 water distiller or a filtration system, and I'll get around it that way, as opposed to spending $1.50 for filtered water, which is really from some big city public municipal water supply, which is true, right, for our two largest providers in the U.S. You can look that up. I believe it's from Detroit and Michigan. Michigan, I think, in Chicago. Anyway, they reasoned that it was cheaper, they didn't have to lug it, it was better for the environment, and of course it was better for their finances, which is why that. But Shane thought out of the box, or we'll say out of the bottle in this case. His solution choice was to, instead of paying cash or using a debit card for regular purchases, he started using a credit card with a 2% reward on all of his purchases. And the card that he chose automatically transferred the rewards directly into his brokerage account. And these cards still exist today. And in the end, I'm going to show you how Shane expands this approach to attain 7% risk-free. But just stick with me as this starts to evolve. But now, so Shane uses 2%, and he just no longer has the lifestyle change that was required in the original thesis that was proposed to the group. At the time of this study, U.S. Budget statistics showed expenses for the average family around $53,000. This was more than enough to get to Shane, who needed $2.76 a day. But the key word is here, directly. The strategy directly transferred the money to his brokerage account. Revelation number 5, this will not surprise anybody, voted as the second most important aspect of being a successful investor, discipline. Right? For this strategy to be effective, Shane had to actually invest the reward money and pay the credit card each month in full. If you read the Wall Street Journal today, some people are not doing that. Rates are very, very high. If you read that article this morning, it was very interesting. right? The best strategies in the world won't work if an investor doesn't follow them. In fact, it's routinely found in hindsight that the reason that most investors fail is not because of the strategy, but because the person failed to follow their own strategy. They started jumping from one thing to the next. In fact, a 2022 study by Galbach showed that over the previous 30 years period from the S&P 500, the average return was 9.65% on the far right, while the average equity mutual fund investors' return was only 6.81%. Now, there's probably many reasons for this, but certainly one of them could be that emotions cause many investors, presumably without a plan, Revelation 1, to chase price and uptrends and to panic in downtrends. Revelation 6, I want to make sure I didn't double click there, or I didn't. Revelation number 6, good investors and really traders for this one had the ability to take action and the confidence to do so. This was thought to be the second most important human attribute, at least for traders. You had to have confidence and belief in yourself and that you would be successful in your ventures. Some good news, Revelation 7. The group as a whole believes that investing plans and strategies do not have to be complex to be effective. And here I will state, and I can state this, that chart reading has a definite law of diminishing return. And we're going to look at chart reading in a little bit. The truth is that an investor can gain a large percentage of the benefit of chart reading while only knowing a small percentage of the technical theory. 2 or 3, maybe 4 key patterns, maybe a couple indicators is by far the most that most investors will need. Now, here's a couple of examples of some simple strategies for mutual fund investors, just to kind of get us warmed up. In this table, we can see the results from a study published in Stocks and Commodities magazine in 2023 on the average returns of each day of the week on the S&P 500 from 1965 through June 2023. And as replicated by many, they showed that Mondays were the worst performing day of the week, with an accumulated average yearly return of a shocking minus 1.75%. And it only gets worse for small caps, with the Russell 2000 coming in at minus 2.19% as measured from the year 2000. I mean, look at that differential there between Monday and the rest of the days of the week. Now, how might a mutual fund investor use this? Well, they could time their periodic weekly purchases on a Monday, right? Getting lower relative entry prices. Another reasonable approach might be after a major sell-off in the previous week, and we see this all the time with investors, to consider refraining from reviewing your account on the weekend, getting sticker shock, panicking, and then entering fund redemption orders. These orders are going to be filled at Monday's close, which is historically lower. There's a reason that Mondays tend to be lower overall. At least according to the statistics, you might be better off waiting for turnaround Tuesday, right? And getting probable higher prices if you still want out. These are simple approaches. Here's another one. It's believed that it's been measured that the last day of the month and the first day of the month are the best performing days. Okay, the Journal of Wealth Management published a study reinforcing this phenomenon. So for those who dollar cost average for purchases into mutual funds on a monthly basis, perhaps they should consider not transacting at this time like most investors do. Right? Their research suggested purchasing on the 23rd of each month and doing periodic redemptions, if you're doing it that way, on the first. Simple approaches that have merit and validity when we look at the statistics. Revelation 8, intellectual-based investment research approaches and strategies seem to be more effective. This is a pillar of AAII, evidence-backed research. I am going to show you some evidence-backed research and methods coming up. Here is belief for no other reason. If an investor believes in and understands a strategy and there's evidence to support that strategy and its effectiveness, they're much more likely to follow it. And they have a better idea of what's coming, and they're not surprised by it, and they don't get shaken out. Revelation 9, when considering any investment strategy, it's good for an investor to be skeptical and to be sure what they're looking at is accurate and realistic. That will be the big ending today, I'm telling you, right? The 10 reasons 10 reasons why you may want to sell your stock. There are many potential problems with strategy evaluations and back testing. There's changing market environments, biased time periods, selective symbols, curve fitting, over optimizations, corollary illusion, confirmation bias tendencies, incorrect selections of outliers and artifacts. The list goes on and on. I can make any strategy look good, a bad one, and I can make a bad strategy look good. I can do it both ways. There's a lot of tricks to this trade. I'm assuming many people in this room know these tricks, but I'm going to show you some of them. Coming up in a section. Revelation 10, even with the best of intentions and exemplary research, investing strategies are still about probabilities. They're not about guarantees. Strategies, approaches, and methods are what they are. They're not infallible. No matter how many things line up, there's never a guarantee the approach can still fail. Well, that's why we use risk control techniques. Risk control techniques will be looked at in section 5. Revelation 11, sound investing strategies focus on risk first. Buffett's 2 rules of investing. We all love Warren Buffett, right? Rule number 1, we never lose money. And rule number 2 is somebody...
Never forget rule 1.
Never forget rule 1. Thank you. I should give you something for that participation, sir. Right? Now, with that, though, I'm going to throw you a curveball here. And I'm going to tell you when the important slides will come up, and this one's important in 2. Yeah, although there's a definite correlation between return and perceived risk, this is a fundamental principle of finance in the investment world. We would agree with that. There has to be a point of balance. And I'm going to try to take you out of your comfort zone here a little bit. Although it may not be the 8th wonder of the world, and Einstein didn't say it, at least originally, right? Compound interest is an extremely beneficial force for investors. We just showed that with $1,000 a year for 18 years ends up at $12 million to give your grandkids, right? And it often has a greater effect than we anticipate. There's 2 well-known rules on compound interest. I'm just refreshing them here. Number 1, the more frequent the compounding, the greater the effect. I'm getting lots of head shakes here. Yeah, knowledgeable audience, I appreciate that. And number 2, the longer the time period, the larger the compounding effect. Those are the 2 big ones. There's other ones, but those are the 2 big ones. So Revelation 13, start early and investing something is better than investing nothing. But to start early, I want you to look here at the halfway point at the bottom of the screen. After the first 18 years of contributions at year 26, in our example with Shane, at that point, he only had a profit of $748,000 after 26 years. In the second half of the next 26 years, Shane now accumulates $11.28 million more profit, right? With younger investors, and I do a fair amount of lecture in academics in the college, I've done a little bit, they just don't want to hear blah, 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 show me how to day trade. They want the quick dollar. They want the action, the excitement. But this is a true relationship. It's a mathematical certainty. Revelation 14 is something that many older investors, they don't want to hear this one. You see in this room, we don't have any of them, but I'm going to cover it anyway, just to cover all my bases here. Revelation 14, and this is where I'm going to try to sway you a little bit now. A few percentage points more of return make a big, big difference in the outcome. In this table, we see that a 5% return with the perimeters of our example with Shane give us a final balance of about $363,000. But at an 11% return, that's where Shane gets to his 12 million plus. So the return really makes a difference. That's why we become investors. Oh, I'm not going to do all that for 2 or 3% more. Well, that 2 or 3% more return can make a big, big difference. And it's right there, 363 and the 12 million. Now, this is the critical slide here, and many investors don't know this relationship. Percentage return differences are not linear. percentage return differences are not linear. A 3% increase in return from 2 to 5% only nets an additional $303,000. And this questions the strategy of reaching for yield at so-called lower safe target amounts, where many older investors tend to want to be. And this becomes a function of supply and demand because so many people want to be there. I'm a member of the National Association of Active Investment Managers, and you hear all the time somebody will say, make me as much as you can, but don't lose anything. Well, that becomes a crowded trade, right? A lot of people want to be there. But now look over here, a same 3% difference from 11 to 14%. Yo, an extra $54 million, right? The same 3% difference. So it pays, if your circumstance warrants it, to reach a little bit to get that extra return, because that extra return really magnifies itself. It's not a linear relationship. And it leads us to our final observation. I'm going to ask anybody, I gave you the answer, so I'm not even going to ask you because it's up there. Do you believe Warren Buffett said this? If I was running $1 million today, or 10 million for that matter, I'd be fully invested. Anyone who says the size does not hurt investment performance is selling. The highest rates of return they've ever achieved in the 50s. I killed the Dow. You ought to see the numbers. It's a huge structural advantage to not have a lot of money. I think I could make you 50% a year on 1 million. No, I guarantee that. Warren Buffett. We as small investors do have a huge advantage. And there it is right there. And he said it in an article, The Homespun Wisdom of the Oracle of Omaha, in July of 1999, just to give you some frame of reference. We have quotes in the course from Peter Lynch, etc. But this is a fundamental theme, that we're small. Individual investors, we're not regulated, we can do what we want, we can go what we want, we don't get hurt. So anyway, this is, as a small investor, Shane decided to try to take advantage of this. After making large purchases and he deposited 2% into his brokerage account, he took advantage of one of the plethora of 0% credit card offers available at that time, right? So he opened the new 0% card and then transferred the balance from the 2% card there so he didn't have to pay it off. At that time, there was so much competition to attract debt. For those that didn't pay their balances off, again, the Wall Street Journal article, there were no transfer fees and the offers were extended 12 and 18-month long periods. Now think about this. With this approach, Shane gets his 2% award in his investment account for buying something and then takes that money he would have used to pay the 2% card off and floats it to buy 6-month and 1-year CDs. They were paying over 5% at the time. When the CD expired, he took the principal, paid off the 2% card, and enjoyed a 7% relatively risk-free return on all his purchases. He's now using his small size against the big boys. He's turning the tables. And it makes sense. It's a good approach. He does many other things to get this now into double-digit areas where I just showed you we want to be. That's covered more in the course. I've made my point on this. And it all leads us to Revelation 15, the last one we're going to cover here. The building of wealth through investing is possible for the individual investor. And it does not necessarily take a special skill set, sophisticated strategies, lots of money, a lot of expensive equipment, or complicated software. But it does take sound investing approaches and a plan or a set of strategies. And that's what we're going to focus on in the rest of this presentation, about strategies, design, and we're going to look at some ways to generate, hopefully, extra return. Now, I'm going to see if you were paying attention here. So here's a quiz. Okay. How much do you think saving, say, only 5 cents on a buy execution on 200 shares of stock would improve your returns? For this example, we're going to say only 35 years out. Now, we're not going to give the money to our kids. We're going to keep it for ourselves. Okay, at an 11% annual return. And we know what the 11% return is. Average return of U.S. equities over 90 years. How much do you think? 5 cents, 200 shares? Oh, that's $10. Hey, and the answer is, because we've already covered this, The answer is that you would have an additional 375 hours for every $10 gain on an entry or an exit with these parameters due to compounding. Think about that, $750 more money, 35 years out, at 11% return on each trade by just getting 5%, saving 5% on your entry and exit for ETF options or stock. And options would be times 100, of course. Okay, by just $10, we're talking hundreds of thousands of dollars for the average stock trader. And it's what separates astute investors from everyone else. And I'm going to try to show you some ways to get that 5 cents and a lot more in this next section. Okay, and we're going to look at orders and execution. Okay, we know small percentage returns can make a big difference. This is a mathematical certainty and why our first strategy we're focused on. But orders and executions for stocks, ETFs, and options is what we're going to look at, because I just gave you a few basic ones for mutual funds on whether you might be able to improve returns there. I'm going to show you $1 million one for mutual funds in about 11 slides. I know you're going to say I'm lying, but I'm not. Okay. How many people have read Michael Lewis's book Flash Boys or heard about high frequency trading? It was a little while ago that book came out for you. Okay. On this next slide, and we're going to have some videos. These are going to be for you. Hopefully you'll find these of interest. And this one is not mine, just so you know. I never use anything that's not mine, but this is an exception. What you're seeing here is the orders between various exchanges on Radio Shack. And each box represents one exchange showing its national best bid and offer. Now we know this is over, okay, because it's, again, on Radio Shack. But you can clearly see the amount of flash orders and front running that's trying to go on here. Now let me tell you something, folks. This is slowed down not 40, 400, no, 4,000 times. I'm slowing this down 4,000 times so you can see this. This is in milliseconds. So please do not tell me that the market is not trying to pick your pockets on orders, because they are. Okay? Now I'm going to show you a video on this, and this is my video from a live trading session, and it's extremely telling and impressionable if you've not seen this phenomenon before. And just so that we're on the same page here, what you're going to be looking at is an order matrix. It's a live direct, and you'll see the bid price over here, and the bid is what we receive, right? And then you're going to see the offer, the ask price up here. That's what we have to pay. And then you'll see my order rate in the middle here. And the spread is what they're taking, 9 cents. We show it on 5 cents. It's what the market wants. Every time we execute, we're losing this. So here we go. This is on GLD, the ETF for gold. You can see my order here. Here it is. I pull it up. Oh my God, it moved. I pull it down. That's all right. Whoop. I pull it up. Up. I pull it up. What do you see? Every time I'm moving my order, computers in the market is shadowing me. They're trying to stay to the inside to a certain point, and then they back away. They're trying to front run us. They're trying to confuse us. Okay, great, right? That was interesting. It was entertaining, I guess. But how do I use this, and how do we make some money here, right? Well, the first thing I'm going to tell you is, and this one's addition by not subtraction. As a trader 25 plus years, and I'll leave it at that. No matter what people try to tell you and sell you, never trust what you see in the order book. Okay? It's a mirage. It's there to put you on the wrong side. Don't pay for it. Don't learn how to read it. There was a time, maybe in the late 90s, when there was validity to that. It doesn't work. So if you want to try, you're more than welcome to, but I can show you my opinion, and that's what I'm here to express. And even people like TradeStation who sell order books and things, they'll tell you in their lectures it doesn't work. There's nothing there to be used. Okay, let's get to order types. You may say, I know market and limit orders, but I'm going to show you some more stuff. I have stuff for beginners all the way through advanced here. Now, I won't say that you should never use a market order. And a market order is what? I want to buy or sell an investment, but you don't tell them a price. Right? I want to buy 100 shares of stock ABC. You hit the market order button and flip your fill. Okay. So why know the market orders? Because as you saw, you're going to give up the bid and ask at least, and more so that it's actually going to move away and you're going to give up even more. Okay. And if you question this, ask yourself, how do brokerage firms, offer no-cost transactions? How can they do that and stay in business? Well, they're making money somewhere. They're just doing it in a less transparent way. They're doing it by selling order flow. And they're all doing it. I'm not picking on any one of them. A market order, there was an old belief that market orders guarantee fill but not price. Is that true? God, no. Wouldn't that be nice if it was true? Market orders do not guarantee fill. Right? We get delayed openings, we get haltings, markets get crossed. Matter of fact, I would say to you, the only time I'd ever want to use a market order is the time that they won't let me use it. Right? We're last in line. Nobody's our friend here. They're not here to help us. I know it's kind of a negative way of looking at things, but I think that's the way to approach the market. So if not market orders, then what? Limit orders. And with a limit order, you tell the market the most you're going to pay to buy an investment, or the least that you're willing to expect for the sale of your investment. For example, if you want to purchase a stock that's trading at $95, you can enter your order to buy it $94.95 or lower, or I'll sell it, but at $95.05 or higher. Now, limit orders aren't perfect either. And there was an old belief with limit orders was, well, they'll guarantee you your price, but not the fill. And is that true? Really not. And there's a one word for it, and it's called gapping, right? And we're going to look at gaps and how to counter gaps in a little bit. But you can put a stop limit order, say, at $95, but the stock could open the next morning at 65. Your order means nothing. They bypass it. They jump over it overnight. So it doesn't guarantee that you'll get filled there. Although I certainly think it's a better option than a market order. Now, earlier we showed you how much you could be losing by sacrificing 5 cents on each execution of 200 shares down the road. And here you can see the amount that you can theoretically save on stocks by simply joining the bid or ask. Just join the bid or ask on a NASDAQ 100 rather than using a market order. And you can see the amounts. You're not going to see this up there in TV land, but right here, look at the amounts. And this is in real time right here. This is a NASDAQ 100 and 100 shares. You'd be saving 70, 50, 40, $30 at a pop. That's on one side of the trade by just using limit orders and joining the bid or joining the ask. Never mind using some of the techniques I'm going to show you future to get actually better prices. Okay? This tool is actually one of the AAII tools that's in the course. It's free. And what this tool does, it recommends which type of order to use and at which prices. It's a good guideline. It's a good tool. You answer a series of questions, and then it does that for you. Now, here's another example. Let's say a stock is trading at $10 with a 20-cent spread. It's a little wide, but let's just go with it, okay? Even based on a potential mid-fill value of $10, a dividend investor could theoretically be giving up 2% on the buy and sell. That would be the entire dividend yield just to execute the trade. You're giving it up. So we don't want to just hit the market order and take what they said they're going to give us and then move it even further away. We want to use limit orders. We want to protect us. You're putting money out there. They're going to grab it as quick as they can. Now, this is a good slide. For those of you saying, well, this is why I use mutual funds to avoid this. I don't worry about this stuff, right? Sorry, mutual funds have the same slippage, if not more, because they have to fill such large orders in the securities being held in the funds. You're just not seeing the losses because they're reflected in the lower return figures. And with mutual funds, you have fees. Think this doesn't matter? Look at this slide. In this table, you can see the differences in return with investing in mutual funds, ETFs, and a no-fee investment. Wouldn't that be nice, right? At their respective average fee levels with the same parameters of our example with Shane. We're talking about $1 million return differences between a mutual fund and an ETF. Well, where are you coming up with these fee numbers? These fees are from the Investment Company Institute, the ICI. They reflect the average fees for U.S. equity-based investments in 2022. We're talking $1 million over a lifetime in just what, a 0.2, 0.3% difference. That compounding effect, every penny matters. You're at the poker table, every hand matters, every chip matters. That's a stunning, isn't that stunning? And it reinforces what John Bogle said. I assume we all love John, right? Cost matters. Cost matters. Don't overlook any aspect of investing if you can. This is a slide from Morningstar's Ben Johnson, who does a class in the EI course, showing the advantages and disadvantages of mutual funds and ETFs. And if they do matter, and they do, ETFs by essentially all metrics, now that there are no more transaction costs, are better than funds if available and appropriate. And if you use ETFs or stocks, then they matter, as does education, as we continue. Back to limit orders. These are not perfect, but they are more practical, and they give us a lot more control and flexibility, as they allow us to set order at strategic locations at better prices off into the future. It allows prices to come to us. And this is certainly a better option as opposed to entering and filling an order when you just happen to be sitting at a computer, which is very unlikely the best price that you're going to get. But the question becomes, how do I know where to place, or at what price should I set my orders? And that will be a focus coming up in the next section. Now, please note, right, there's dozens of types of other orders, and they all have potential value in the right circumstances, so don't quote, limit yourself, yes, a pun. Many of these are covered in the orders and execution class, and a professional trader would use this in many, many more types of orders and much more sophisticated methods. We would automate them. Just keep that in mind. But I want to make you aware of one type of order that many, many retail investors don't use, and that I think that you should, and many are unaware of it. And it is a bracket order. How many people use bracket orders in this room? Okay, thank you, sir. And what a bracket order is where you can put your profit target and your stop loss in at the same time. And when one side is filled, the other side is automatically canceled. An example of this would be I purchased a stock at $100. I want to take some profit when it hits 120. Okay, but I want to get out if it hits 90. I don't want to lose more than 10% on the investment. With bracket orders, you don't have to decide if you want to place protection to reduce risk or a profit if I get a big jump up. You can have both at the same time. Now, they're very powerful and they're easy to use. You just fill in the template that your brokerage firm provides. Basically, you're entering two prices instead of one. And there's a reason that essentially all brokerage firms now offer these. Fidelity, you name the brokerage firm, they're there, and they have videos and instructions on how to use them. It's just that the word isn't getting out to the retail investor. So my purpose today is really to make you aware of them so you can research this on your own. I'm going to end this section. What goes for stocks and ETFs is quadrupled for option orders. In review, the market is watching and looking for sloppy order executions. Save your money and time with order book subscriptions and attempted readings. They don't work. Rarely, if ever, use market orders and save the spread or worse, as I showed you. Take advantage of potentially better fills with limit orders and consider learning about bracket orders. It's your money. It's important. And as the years go by, it will make a big, big difference. All right. I am going to take a 1-second water break here. And we are so far behind, so I'm going to go, how late did we start? Like 25 minutes or something?
Yeah.
Okay, so we're going to do this section and then we'll take a break, or ask you if you want to take a break, and then we'll continue. We can cut something if you want also, it's not a problem. Okay. As you probably deciphered by now, and I've told you, I really have a trader's background. I've been doing it full time for decades before I joined AAII, and you're going to see this coming through more so in the next section. So we looked at why we use strategies to build wealth, the importance of them, a little bit on how to execute. Now we're going to look at strategies for when to execute and at what prices. We have a little humor here, right? And because I found that more traders have a lot more trouble with selling than buying, I'm gonna focus on the sell side here. And really, a lot of this presentation is about avoiding large losses. That's the important thing. So that's what we're gonna look at in this section. Just so you know, we are gonna be using charts in this section. To be sure that we're on the same page, in this section, we're gonna use charts for assisting with execution timing. Which price, do we think it's gonna go up? Do we think it's gonna go down? You know, where should I put my stops? Where should I put my profit targets? Okay, before I get confused, with a fundamental approach, that is the long-term driver of price for stocks and investment selections. And we're gonna use a technical approach for shorter-term directional information timing. We want to synergize both methods. This is an AAI group, so I'm assuming that many of us use fundamental analysis. Do I need to do a primer on chart, or can I slip? Does everybody know the basics of a chart in this room? Yeah? Yeah? The basics of a chart? Okay, I'm gonna skip this. These are candles, you got it. I know it. This is what a chart looks like, time left to right. Okay. So this is a chart of the S&P 500, and there's gonna be a few things that I do want to cover here before we get into this. A trend. Trend is just the general price or the direction of a market or an asset. This is a chart of the S&P 500. We have uptrends, downtrends, and sideways trends. We refer to them as range. Sometimes we have noise. And this chart shows us an important relationship. It's not really clear, but the relationship is this, that markets tend to rise slowly and they tend to fall quickly. And I say, okay, well, everybody shakes their head on that. Yes, we know this, right? There's an old saying, price goes up goes up the stairs and it goes down through the window, right? And we have to deal with this. But by knowing this, we form our strategies accordingly. And we know we need to get out relatively quickly because price is going to drop. Another concept that we need today is just called support and resistance. I'm hoping everybody knows this, but I'm going to go through it quick. Down around the 78 price level, this is a chart of Berkshire Hathaway right here. We have something called support. Support is a price level in a chart where the market has shown previous demand for an issue, where there's been a past interest to accumulate shares. Some would say this is where the smart money buys. Think of up in support, support. Resistance is a price level in a chart where the market has shown previous supply for an issue, where there's been past interest to accumulate. Previous supply for an issue. There's been a past to distribute shares. And we can see it right there when it's hitting a certain price point, people are trying to get out. If you're new to this concept, just think of resist like a ceiling. You know, you can't get through, you're pushing on a ceiling, price is bouncing its head. So we combine concepts of trend with support and resistance. This is all we'll work with today. Downward, upward, and sloping trends. And they're very common. We see them when we look at price all the time. This is called a PPC, or parallel price channel. There's various names for it. But we get this trend and we can clearly see clear support and resistance areas with the trend. Okay, so this is how it's taught for long entries. And I'm going to show you how it's taught, and I'm going to show you how to make money at the very end. And this is true. But right now we have to learn lessons before we break them. So this is support, and this is how we're taught how to do this. We would look to either buy our long entries when price comes back into support, or we would look to take long entries over broken resistance. And we see this a lot with new highs. So that's how we're taught. For exits now, okay, I'm in a position now, when do I get out? We either want to look to liquidate our positions by taking some profits on formidable resistance in this area every time it gets back up. And we definitely would like to look to get out on a break of major support. That is unquestionable. That's an area you want to get out of. So we put this together for perspective. This is a chart of gold for an article I wrote for AAI a long time ago for the AAI Journal. I'm going to show you how a technician would read this rather quickly. In TV land, you have to go by the numbers. But we can see clear support here at A, point B, point C. So we'll say theoretically around this area, if you were looking to buy and get into gold, all the buyers in the market would be looking to buy at point C. Sure enough, price forms this little bullish bowl. We see the downward sloping trend line at point D. When price jumps back through the void, where's price most likely to go? It's not a guarantee. Point G, point EF. Now we have resistance. From point G to H, price starts retracting back. We see a little bit of a battle, right? Nope, the bulls can't hold it, and it falls right back to point J. The bulls try to reinforce again, try to drive fast price back up. They can't drive it back up. And what happens at point J? Major support is breached, and we see literally 11.3% drop in gold in the price of 2 days. Look at the volume and intensity right there. Okay, so this is how a chartist would read this. It's just a bunch of lines. There's no reasoning to this. There is reasoning to it, and that's what we're going to cover. But right now, that's how a chartist would read this with support and resistance. Okay, and here's some past examples of some uptrending stocks. This one's on DuPont. You can see the clear signals where the buyers keep coming in. Here's one on Visa. This one lasted over 2 years. And we have one on Disney. Now, I don't want everybody to go and quit their day jobs, right, and say, oh, I understand support and resistance. I'm just going to make a living doing this. Because there's a problem with executing off these patterns, which I would cover you, and I would try to give you a solution for in a few slides. But stick with me on this. Now, there's a number of reasons that we use charts for forecasting to guide buy and sell decisions. Based on logic, technicians believe that the study of known charted price history, what we know is going to happen, and observing current price activity has value in predicting future price movement. Why do we believe this? Okay, we're going to have a quiz. Ready? On this next slide, I'm going to put a picture of a portrait of somebody. You don't get anything because I'm already giving you a free class. Normally I would. But anybody know who this individual is on this slide right here? No, sir? You guessed it may time. Anybody know who this is? All right. Normally people think it's this man. Leonardo Benici, Fibonacci. No, so normally people think that. So I'll give you a clue. Some people say his works and interpretations of his works are highly controversial, especially in regards to Napoleon's rise and Hitler's and Kennedy's assassinations. Anybody know who this is? Yes, my friend, Nostradamus, absolutely. Ray, all them technical difficulties at the beginning, I stuck with it. You kind of got me going a little bit. I started to believe a little bit what you said, and now you're doing the hocus pocus. We're at Nostradamus here, right? You're losing me again, right? Why is Nostradamus in this presentation? Well, in my opinion, it's a myth that technical analysis on individual security is directly clairvoyant, like in predicting the future. I don't think that any price-based formation or indicator is magical in itself. Indicators are simply algorithms or formulas. Now, this is an important concept, but I do believe in, yes, it could be illogical, but it's still very real, the self-fulfilling prophecy of price patterns and formation. It's the participants' beliefs that gives the technical studies its subsequent importance. And this becomes more relevant as the number of people following them also increases. There's nothing magical about a 200 period moving average and a 50 period moving average, but because we all believe it, it becomes relevant and money moves off of it. It reacts. Otherwise, what people believe often prevails over truth. I'm going to drive this point home to you. This is the key point. A whole lot of traders, investors, and a bunch of programmed computers, a ton of money, are all looking at the exact same charts and are all waiting for the exact same triggering signals to determine the likelihood of probable future price action and if and when they should buy or sell. And because of this, it creates a self-fulfilling prophecy to the price formations itself. It gives us an element of predictability for reading probable future price movements and setting executions on our strategies. And this is undisputable. If you wanted to debate it 20 years ago, you could have. Fast money, you go down the TV, you go down the programs, AI is coming in. This is being reinforced more and more. Technicals matter, and whether you like it or not, these lines can help us, and money moves at least short term off of these lines. Okay, here's an example. Say an experienced investor became interested in acquiring Apple, we'll say for any reason where the yellow circle is. Again, my friends in TV land, right here. Well, what happens? We see price dropping down to major support at 55. So market forces take over, right? New money is reluctant to buy at 68. Why am I buying at 68 when I think I can get 55? So it causes a gravitation of price to the level. If you're short this, you're saying, wow, I could take my profit here. I think I can get 55. So shorts also win. And what happens is that everybody's fortifying these areas of more probable pivot or turning point for the bullish price action. I want you to look here. This is the case maybe where the tail's wagging the dog. Look at the PE ratio down here. For Apple, at this time, it was a level of 9. It hadn't been that low in 10 years. Where maybe price was just sucking that down because everybody was waiting, and it made the valuation look even better, right? So there's an interaction now between prices and the fundamentals. Here's the example of Lockheed Martin with price on top and with PE ratios at the bottom using support and resistance theory, right? Most of this stuff is time, but you can see support and resistance I'm drawing in. And we can see that a lot of times they correlate. The valuations, and this reinforces our signals, where we can get the support on the price-based fundamentals, and we can get price at the same time. All right. Fundamentals for selections and technicals at a minimum for timing executions. I think it's very hard to make a living unless you have a lot of money as an investor, but as traders, it's a little bit easier. So I'm going to try to sway you to my side for a minute. And I'm going to say, let me ask you this question, okay? With a fundamental investing approach, you're looking at what everybody else is looking at, and you're trying to find someone that no one else sees. What? With a technical investing approach, you're looking at what everyone else is looking at, and you're trying to see what everybody else sees. Now, what is as simple a game? Warren Buffett was going to carry it 2 over. He didn't value that company right. The whole world's wrong. I see it. That's a tough game, isn't it? That's a tough game. I'd rather look for converging lines and waiting for the computers to come in, and I would rather try to make money that way. That's just my approach. It doesn't mean it's right for you. I respect everybody's approach here. And again, please understand, I'm in favor of using both approaches, finding a good list of stocks, and then just using the technicals to help. Okay, I want to make that very clear. Now, there's several advantages to using charts for probable directional insights and to make execution assessments and decisions. With one of the biggest, it helps reduce the emotional component and influence while investing, right? Similar to strategy sections. We're human, and by using technicals, they prevent us from arbitrarily guessing of when to buy or sell. Chart analysis not only keeps us in tune with the overall market assessment, which we care, but they give us something tangible and objective to focus on, and this reduces the emotional component. Here's an example. Look at this chart of 3D systems right here. We can see, if you know what a candle is, right, that price opens way down here. Okay, previous day close was 34.29. It opens at 30.39. It gapped down 11.3%. That's a big gap down, right? But if you look at the chart, you see, wait a minute, it's coming right into major support. Of course it gaps the support. It's called priming, right? Point of neutrality. Price loves to jump to a point of neutrality, right? So price dropped down there. Maybe you would have said, wait a minute, it's down 11.3, but I'm right on support. And what happens? Well, you know what happens. I'm going to tell you a story about Jim Cramer in a little bit. But price goes up, makes it all back essentially, and it has a 33% move in 2 days. If you weren't looking at the chart and you just said, 11.3%, you would have gotten faked out. Okay? That's an example of what it would be. The truth is that you can't judge stock price moves simply by the magnitude or based on the tonality or objective used by some investment show host or by what somebody writes like me. Right? Some 3% moves are highly significant, and other 10% moves are just normal retracements. They essentially mean nothing. And you don't know this if you're not looking at a chart. You're at a tremendous disadvantage if you invest in stock. Now, this quote isn't famous, because it's mine, but it highlights a critical concept. Technical patterns and trend lines don't tell us necessarily if a securities trend is going to continue, but they do indicate when and where the trend or reversal is most likely to occur, if it's going to do so. The stock is going to do what it's going to do over the long term. Trend line or not, fundamentals rule. At one time, Enron, Bear Stearns, and Lehman Brothers were all at major areas of support on the way down, and they're still not worth anything today. Technicals don't tell us if it will happen, but they give us a clue where it is most likely to happen, giving us areas to focus on to make short-term directional determination and execution signals. So should we sell or not? What exactly do we look for? I'm going to give you a few basic ones here. Hopefully I'm whetting your appetite to learn more about this. We want to follow the big money and stay with the prevailing momentum, but we also want to get relatively early if there's a true trend change. And the $64,000 question is, how do we identify a normal, inevitable price retracement and subsequent continuation of the trend? Right there, there it is right there, from something that looks like this when the trend is really breaking. And I'm assuming that you already know these answers. How do we know that the trend is broke? We want to be out. We don't want to be out first, but we want to be out strategically early. Well, Dow theory addresses this sort of. It states something similar to Newton's first law, that we always assume a trend is intact, till broken, or the weight of technical evidence dictates otherwise. Okay, well, thank you, Charles. But what is the weight of technical evidence exactly? It's kind of vague and ambiguous. I'm going to give you a few things that you can look for frontline determinations. One of the most basic patterns to look for if you're new to this approach, just look for topping patterns. There's many variations with double tops and triple tops and head and shoulders. You can read about them, but they all have the same principle. There's a slow change over time from the accumulation of shares at higher prices to the distribution of shares at lower prices. And if you're very new to this, when price smiles, things are usually looking up, and if price frowns, things may be on their way down. Go back, look at your stocks, see if you see these curves in the starting of trends, up and down trends. You will see it over and over. Now, why do downward and upward turns happen so often and so uniformly? Because big sellers and big buyers, for reasons no one else probably knows at the time, don't want to alarm the market of their intentions, and they don't want to hurt their prices. Warren Buffett selling Apple, right? Elon Musk, right? So they slowly distribute their shares, forming these patterns. In the past, we used to use specialists or market makers to do this for us. We just tell them. But now computer algorithms are constantly judging and measuring price dynamics, feathering in buy or sell orders, and they cause these formations. And it gives us an element, something to look for. Now, another way to evaluate trend and changes in trend and momentum is to simply look at the patterns and directions of the pivot point. This is a good method if you're new to charting. In this case, the price action is confirming if we continue to see higher highs and higher lows. We say the trend's intact, it's still going up. The pivot points are saying that's what we should do. Okay, that's one way. Look at pivot points. We'll look at the S&P 500 and try to apply some of this theory. And with this approach, until we see a change to a lower high and a lower low, we assume the trend's intact. Sideways price action by itself is not interpreted as a reversal. Even in the strongest trends, price war times kind of exhibit short-term neutral stabilizing like retracements. So that's not considered a reversal. This is the last slide in this section, and I believe we can take a break if you want. We only focused on the sell side today. This is about a 40-minute presentation, but I tell you and show you some good statistics on what you should look for buying. But it goes something like this. I wrote it into one paragraph. If you wanted to a value player, and I like buying stocks that are depressed, but where should I get in? When do I think? You'd be looking for something like this. You'd focus on stocks with strong fundamentals that have been falling with the market. Relative strength is important. On decreasing volume, we want to see the intensity of the selling get smaller as it goes, and that have formed clear, well-defined, relatively shallow angles. If it's going like this, don't touch it. It's coming down with the market, shallow angle trend line, relative trend over a long time frame with multiple widely spaced touches, and then it's broken out, and you can see it on high volume in a gap. That's Nirvana right there. Putting all the things together. I'm a value player. This is what I'm looking for. I like buying stocks on the cheap, so say cheap. That would be a good technical setup. Okay. We have some base theory, okay? And in this chapter, we're going to look at some practical when to sell applications, first for chart reading, but if you don't use charting, I'm going to give you some for mutual fund investors and all types of investors. The concepts have been trends and support and resistance easy in theory, and they do seem logical in principle. I wait for price to come down, I'm getting it lower, it touches the line, and then I wait for it to start to curve up. That's important, by the way. You never anticipate, you always wait for confirmation. You wait for the big boys to turn off of these lines, okay? Don't jump on it, okay? That's not really covered in this presentation. I mean, it only comes so much in an hour and 35 minutes or an hour and 40 minutes. But even though it seems logical, it doesn't always work, and you can't quit your day job. And the reason is why. Why can't I just do this? I look at the chart, I see it touch, oh my God, I see it. It's Nirvana. You're absolutely right, it's there, and you will see it if you look. Okay? But it doesn't work. Why? Because you will win more often. You are buying at lower prices, you're waiting for prices to come down, that makes sense. But when you lose, you're going to lose a lot more. And that's what I'm going to show you right now, and some ways to compensate for that. And that's the problem with it. When technical support areas break, they do so quickly, and often price gaps, meaning it closed at 95 and then opens the next day at 90. Gaps show the big boys are stepping in decisively and with conviction, and that there's a large order imbalance, and that the market is willing to accept much less to get out quickly. And here you can see an example of this. Unfortunately, people are not going to see out there where I'm pointing to, but support, support, support. You see it. Price goes up. Support. Where does price pull back to? Support. And then what happens? Bang! Gaps down. Oh, I was at support. I wanted to get out. Well, now it's too late. Right? Look at this. Beautiful bullish bull pattern. Ray, you said bullish bull patterns, price should go up. I see the accumulation of shares at lower price, the distribution of shares at lower, through the accumulation of shares at higher prices. I see it. Well, look at this. Price doesn't even come back to primary resistance and starts to pull down. That's fading previous support. People weren't even willing to wait to get back to the most logical area. That's a key sign. We're reading this right here. Here's a classic island reversal pattern right here. Price gaps down. Whoa! Pauses and then gaps right back up. A very strong signal. The price reading charts tells you something, the emotions and what is going back on. It's just not random numbers. So here's one more example of this. On your right, price jumps down from support. You see the gap. Support, 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 support. Price jumps down again. Bang, support, resistance, 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 comes back to support, the buyers come back in. What happens? I gave you the rule. When support breaks, look out, whoa, down, right? It dropped, resistance, 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 it can't get up. We have an asymmetrical triangle right here, or an ascending triangle. When price breaks support, what's gonna happen? Price jams down again. We have, this is called capitulation right here. Right, this is a pennant formation. You measure this distance to that distance, and that's what price you go. And if you're not measuring it, I show you computers are, etc. This is how chartists read. The key point is gaps. When we see a gap, it's not going to let you get out. This is the S&P 500 right here, and gaps from extreme levels. I'm going to talk about this indicator in a little bit. It's called Rondeau's reversion. But you can see right here, prices are extended, and we get a gap right there. Prices come back down. You can see. We see one right here. We have a price gap, and then prices came down, and then we have this thing up and away again. I don't know why. And we have one right here. So we're seeing gaps even when prices get to extremes and then they gap away, people feel trapped and it often starts a new trend. That's on the S&P 500 right there. So to compensate for gaps, we need a strategy. If you're using support and resistance or even moving averages and you get a technical breach, I'm going to tell you some things not to do and then some things to do. What I would not do is wait X amount of days. Sometimes old timers will come up to me and say, I read John Murphy's book and he said the 3-day rule, if price breaks support, wait 3 days. If you wait 3 days, you could be in negative numbers. Markets move so quickly now. Technical analysis of financial markets is a great book if you want to start learning about this. Okay, there's a book that I started with, many started with. But the markets have changed since then. So do not wait 3 days. Another thing, and we didn't cover this, was support and resistance are often interchangeable. If price breaks support, it often comes back and tests resistance and then rolls back down. It does a stepping type motion. And that's what we see. The statistics do not warrant on a break to wait for price to get back. Sometimes it will go back, but when it doesn't, it just falls. And you can see right here, we had a classic gap right here, and it really never came back. So the question is, all right, we told me what not to do. Hopefully you're going to tell me what to do. There's another one not to do. Similarly, I would not recommend some static X% loss rule from your entry price. I know. I debated IBD on this one. They gave me a very good answer. I won't go into it. Okay. A static X% loss move from a technical barrier is a better choice than nothing. So you could say, well, if it drops 5%, or if it drops 8%, or it drops 11%, I'm going to get out. The key here now is a mistake that most people make is, well, I bought up here, so I'm going to put a 5% stop loss. Nobody cares where you bought. The market doesn't care where you bought. You don't measure your stop loss from the 5% to try to avoid. You do it from what everybody else is looking at. Find the biggest technical barrier on a chart and go 5%, 8%, 11% from the barrier, not from you were. You can say, well, 5% from the barrier is too much. I lose too much from here. I can take it here. Well, the 5% can bring you back to support. You don't want to do that. Okay? What you want to do is just take a smaller position size. So there's a better way to do this than just picking 5, 8, or 11%. And it uses something called ATR percentage. And ATR just stands for average true range. And it's simply the average distance from the high and low plus any gaps that occur. Very simple. You can find this anywhere online. And there you go. You can find it. We also give it to you in one of the AAII tools that shows you where to put the stop losses. And you take this amount and you multiply it by 2. And then you're going to place that below support and not where you bought it. And I'm going to show you an example, and this will all make sense very quickly. In this gold example, we clearly had support here. You can see it, right? And at that time, gold was moving about 3.25% a day. That was the average move on gold each day. Multiply it by 2, 6.5. So now you're going to take a 6.5% loss. You go 6.5% below 1546. And it was around 1445. And that's where you probably consider saying, okay, well, I bought up here, gold was turning, but if it drops down to here, I think I'm going to get out. And what we're trying to do here is we're trying to get out strategically early, okay? But we don't want to lose too much money, right? We don't want to put our stops way down here, we lose too much money. But if we put our stops too close to the line, what happens? They go down, they grab it, and the price goes right back up. So we're trying to find an area that I'm not losing too much money, but it's just not so close that noise is going to pull me in. So I'm just giving you a basic guideline here. It's a good starting point. Now, after all considerations and all the analysis methods that we covered, show what to do. And there's always going to be conflicting signals in times of indecision. I have some actionable suggestions for you, but I'm not going to do an actionable suggestion until somebody looks at this slide.
Yeah, what is that?
Right. Okay, so he gets the free course for $399. Way to go. Just I'll give it to you after. Okay. Somebody said it online, but you don't get it online. You have to be here. Sorry. Okay. So here we go. There's always going to be conflicting signals in times of indecision. I wonder if Kim did that. And I have some actionable suggestions. I heard somebody yell it out there. First, because the best way to stay out of trouble is not to get into it, and it is. Okay, consider this trading strategy. Do not take any position unless you can verbalize out loud, or even better yet, write down at least 3 reasons why the investment may not be a good one. Interest rates are going the wrong way, a seasonal cycle, political litigation, potential litigation, high valuations, insider selling, etc. You want to assure that you are considering the other side or the counterpoint view of a trade. And there's always another side. Price is where it is. One expert says this, one expert says that. They're both experts. This assures, again, that you're looking at that. And this gives an added potential benefit of keeping us out of trouble. If nothing else, it keeps our position sizes smaller. Oh, I really like it, I really like it. Oh, wait a minute, there are some reasons that could go wrong here. And it keeps our position sizes smaller, so we're not losing as much money. And look at it like playing chess against yourself. You're playing this side of the board, okay, I want it, and you go to the other side. It's a good technique and strategy, it really is. The next one is, if you have to risk trouble, then try and do it for as little time as possible. Practice the free trade proposition. And here what we do is we look to sell a portion of our winning position when strategically and technically appropriate, as early as possible. We grab some profits and then moves our stops up. So we'll say if we were playing this trade right here, we bought it here, we start to see the curve. Oh, price is up to here, I bought 200 shares, I'm selling 100 shares, okay, I'm grabbing some profit, and then I move my stop up to assure that we don't have a losing position. I lock in some money, and then minus gap weight. Of course, if there's gap weight down here, we have no control over that. Now you say, well, why do you want to do that, Ray? Well, one, it's good to be in the green, but the other thing is it prevents us from grabbing profits too early. And unfortunately, we like to grab our profits and book them too early. We never let our real profits really run a lot of the time. So by doing this, you're taking some of it off, you're grabbing your profits, and you're leaving some to keep going. And you just follow your stop loss. I would not use the trailing stop, I use the technical landscape of the chart to do that. Now, if you don't do any of these, and you're unsure what to do, try to remember, if in doubt, get out, right? If you're frozen, I don't really know what to do, or put a much more clever way. You guys ready for this one? This is a good one. I didn't write this. Try to remember, it's always better to be out of a market wishing you were in, rather than in a market wishing you were out. And that's a good saying, and it's a true saying. I've missed many, many, many trades that went the right way, but I've also been on the other side. So that's a good saying. And if you're still unsure and can't get yourself to take action if you're in a long position and you think you're starting to lose, another tactic is the portion proposition. Take half off the table, right? If we accept that we're human, and we are, it seems to appease our emotions oddly. If you're in a losing position and you take half, okay, if price goes up, we can sense, if you're in a winning position and you take half, you're booking some profit. If you're in a losing position and you can't get yourself to sell it, well, at least if you cut some of your losses, you're doing better. And if price starts to go up, you may recoup all your losses that you sold on the partial amount. Okay, if you're in a losing position, you can't sell it all, and you say, I'm only going to sell half, and price continues to go down, well, at least I saved some of it. And if it's a fundamental based position, you can then buy in lower, back in, and you reduce your cost basis. So by taking half, that seems like a reasonable approach, or a portion of it. And taking half has another advantage. It reduces the emotional intensity. It keeps us in wise mind where you make better, less emotional investment decisions. Right? Look at it this way. And we could all do this. That's a pretty wide beam right there. Right? But to walk on it, when the emotional intensity and the accompanying indecision increases, like when you're that high, right, we tend to it becomes more difficult. So reduce that emotional intensity. I'm not fearful, I'm not as greedy, and it works better. And this slide always kills me. Do you believe people back then, they did not realize that smoking could kill them? Okay, that's a little bit of humor. Yeah. All right, we have 2 sections left, just so you know. This section is probably the most technical. It may not be for everybody in this room, and then the last section is the big finish. Okay, the last section is like 7 minutes. This section, I just want you to know, it's about maybe 13 minutes long. And it may not be for everyone. But those that don't want to lose the intricacies of chart reading, I get it, I see it, I just don't want to learn it, right? But they still want help with executions, and I don't want something ambiguous, too much this, that, this, too many overlapping things. Give me a signal, up or down, right? This section would be maybe for you, if that's something that you would have an interest in. But I'm going to give you a few strategies, some you haven't seen before, some that you probably have, and it'll be a refresher. The first strategy uses a common indicator, a technical indicator. Indicators called moving averages, excuse me. And you can see these moving averages on this chart, 250-point exponential moving averages. And our signals are going to occur when these lines cross right here. And they signify important changes in momentum. A lot of people in this room are shaking their head. They already know this strategy. And you should, it's a good strategy. So what's going to happen here, we're going to look for something called the golden cross, where a buy signal occurs where a 50-period moving average crosses up over the 200-period moving average. And we can see that with the green arrows, right? This is a chart of the S&P 500. And a depth cross signal occurs when a 50-period moving average crosses down under the 200-period moving average, the red arrows right there. This strategy's strength is that it can help an investor avoid large drops while maintaining a position in the market the majority of the time because of the market's overall upward bias. Now, is it a sound choice? I think it's a good choice for long-term investors because the signals happen very infrequently. You don't have to check them weekly, etc. Is it effective? For risk control, it is, and I'm going to show you. But for outperforming the market, unfortunately, it's not, although it's close. Okay, so here it is right here. And the dot-com crash from 2000 to 2003, you would have gotten out right here about 9.1% from the exact top. And you would have got back in right there. You can see the buy signal there. You would have gained 32.8% in the market. So it worked there. It definitely worked. Very simple signal. Okay, during the Great Recession, 2008 to 2009, did a very good job. We have something in our way in live land here, but you can see where you got out. I believe you were down. It got you out 6.4% from the top. Nice job, right? It really reacted well. It doesn't get you out you got back in at the bottom. That's not what it's meant to be. You're not guessing here. You would have gained 36% on the market by following this strategy. The key is, at my age, I just can't take a 40-50% loss to my head anymore. I know that they happen. I just can't do it. I need something, that may be able to get me out. So that's what this is for. During the COVID crash, you didn't gain much, a little. This was not typical market behavior. I mean, it dropped. It read the drop pretty good, getting us out, but the Fed just came in and fixed that. They were not going to let the markets fall. The indicator's just not. It's a momentum-based indicator. He turned it on a dime. You gained something, and you did avoid most of the pain right here. Unless you got COVID across them, yeah. Right? But so that's what this strategy is. It's a simple strategy, and there's ways to improve this method from the standard settings by using filters and buffers. Right here, AAII has a free tool coming out, and it's included with the EI course for this purpose. And we're also going to update the signals every week on the AAII's active investing page. That's my area, just for the record. I'm thinking of like an AI technical survey, like an investment survey. And you can see the signals right here. And our current signal, and this is a somewhat current market when I left, it was February. I believe we got the bullish signal on February 2nd of 2023 right here. It did a nice job. It's seen the markets flattening, and it's still bullish right here. And this actually gives you the future price needed to trigger the sell signal, which is impossible because I have to drop to 392. So if this is, I like following momentum. I want a single. I can't take the big loss. This is one way that may help you avoid this, at least it has in the past. Is that fair? All right. Now, I mentioned earlier, I've been a trader for over 2 decades, but prior to that, and as seen in our first segment with the MIT group, I'm a mechanical engineer. That was my training in mathematics. And my so-called edge is twofold. One, I like to take advantage of opportunities as they arise in the markets. And if you follow my material, I do a lot of spread arbitrages and different things. I look for inefficiencies in the market. In fact, I have a segment that we're not going to do today called Beating the Market with Half the Risk. And it's basically setting up a spread arbitrage by two investments that track the same thing, but because of inefficiencies with backwardation and contango relationships, you have a non-directional play. You don't care which way the market goes, and you still make money. So I like to do these types of things, just so you know. I'm constantly looking at the markets evolve, and I like to go where I feel the best areas are. Some people don't, they do the same thing over and over. I'm a dividend investor, etc. I don't do that approach, just for the record. I'm not saying that you shouldn't, though. So here's an example of this. Okay, a quiz. According to research from BlackRock, what asset class has outperformed the other major asset classes 8 of the last 11 years? S&P 500, emerging markets, U.S. high yield bonds, commodities. What asset classes, an Italian table, has outperformed the market 8 of the last 11 years?
S&P.
Nobody's got it yet. Oh, I thought you guys would have this. I did a keynote at what was it? It was in Miami. Everybody got it. Okay, it's right here. And maybe the key word was asset classes. What did it say? BTC, Bitcoin.
Well, I was saying crypto.
Oh, you did. I'm so sorry, Charlie. Dennis, you get it. You get the credit right here, Dennis. I'm sorry. The accent, I didn't catch it. Right, crypto. Right. I mean, look at that. Yes. Right. Bitcoin. 1 in 4 Americans now have some form of crypto. Over 50% of investors own some. I'm sure many people in this room do too. And technicals work excellent on Bitcoin and Ether. But there you go, Bitcoin, crypto, way to go. But what else do you see with Bitcoin in the black? Well, even the time that's up there, 73, 65, right? So you have to have some type of timing. You don't have to, but it really helps. And momentum in crypto really works very well. I'm going to break off here because we have time. So this is a kind of a funny story here. I very rarely have live off my slides, but I'm going to here for a second. Technical analysis is not an exact science. I think we know that. I'm trying to make sure we're about probability. Forbes contacted me. I did an event at a national event. Somebody see me and they said, "We want you to do some analysis on crypto for us." Okay, I said, sure, you know. So I did it. I submitted the article. I believe I submitted the article on March 9th of 2000. I believe it was March 11th of 2000 when they stopped the basketball game for COVID. Yeah. Well, I immediately called them and said, retract the article. I'm like, no, it's too late. It's not going to print. Bitcoin dropped like 50% in the next week and a half or 2 weeks. That was not my analysis, right? So the point is, and we've talked about this, no matter how efficient you are, no how much things line up, there's always elements of things that can go wrong. You know, so my career never recovered from that. But I'm kidding, it did, because I actually, this was in Kiplinger magazine, I think the following year. They put me on page 13 though, and they talked about some of my methods and the way that I approach the markets, and I'm going to talk about one of these now. That's kind of my segue into this next section. It's kind of a little story off the cuff. So I go with the market. I think the best opportunities lie. I'm not married to any of them. And my other approach is to look for statistical evidence when developing investment tools and strategies. And if there's people out there in computer land, they will like this section because this is always going to be about computers. And I do this by back testing individual factors, and then I synergize these factors of relevance to create efficient tools. A simple example of a factor would be this. We've talked about this. Ray, if price gaps up a large distance, does it influence return the next 5 days in the same direction? Write up the program. I say click, test it, and I get the answer. And of course, it does. We know this, right? It's a factor. And then I looked at combine these factors to create strategy. Oh, this moves, this moves, this moves, etc. To me, this is the best way. I don't guess. You can see an example of this, and I'm assuming the video reel when I was talking there. Literally, I can test. This often involves, I write thousands of lines of code sometimes, and then I back test it extensively over decade-long periods on hundreds of issues. We're talking tens of hundreds of thousands of iterations. And it generates very detailed studies with hundreds of fields of statistics and data to recognize relationships and evolve our tools and approaches. I look for linear apex, reverse apex, Gaussian distributions. I'm not into outliers or artifacts. I don't do that. I'm going to show you a couple of examples of what this looks like, then I'm going to give you some strategies. Fair enough? I just want you to know how we arrive at these strategies. People think you guess. Isolating factors is not always easy and it's rarely conclusive, but we do the best we can. Here's an optimization test on conviction. Think volume. Conviction is just dollar volume. With intensity on a price move. Okay? If a stock, and the question becomes, if a stock has a large move up on very high volume, does the volume amount affect what's going to happen next? You said high volume means the big boys are stepping in. Is there any validity to that? And we can see right here, unfortunately, it's backwards. But as the volume goes up, we start here down, right? What do you see? Well, we see the average trade for a profit going up systematically, linear. We also see the K ratio, which is consistency return, getting better. And we see total return to max drawdown. So we start to look, these are just 3 measurements that I look at, but we start to test these factors and say, I don't want to hear what your theories are and what you think. Give me some statistical evidence to prove it. Back it up. And that's what I like to do. And I think it's effective. Now here's another example of this last one. In this table, you can see back testing optimizations of Ballin. How many periods should it be? A 50 period moving average, 100 period, that type of thing. And it's for an indicator R reversion, which I'll show you. And we can again see, as I'm increasing the Ballin, our profit goes up to a certain point, and then it starts to go down. And we call this a Gaussian distribution, right? It gets better and better up to a certain point, and then it optimizes, and then it fades away. This is not random. Oh, I'm picking the cherry picking here, and oh, this peak over here. You're not doing that. We're looking for very straight line. I'm getting shakes of the head. People who've done this here. These are the type of relationships I look for, and a human mind cannot decipher this. You cannot decipher this in yourself. So we combine these factors to produce trading systems, and this is a trading system that AAII has released called kinetic conviction. This system right here, and stick with me on this, is interesting, generated an 81% hit rate at a 3.73 profit factor. On every stock in the S&P 500 from 2013 through 2023. And believe it or not, this doesn't include dividends. Dividends make up about 40% of the return of the S&P 500. It doesn't include that. Not only that, this is only end of day signals, and these results are non-compounded. They were straight. You bought 2,500 on the buy, you sold 2,500 on the sell. So I'm showing you how factors can be used. This is the realized equity curve of the trading system. This is the actual computer-generated curve. It's not something I drew over from 2013 through 2023. Even through COVID, it held, and it's a long-only strategy. I couldn't even put hedging mechanisms into this. I had to make this vanilla as possible. Very consistent return, never had a losing year. Incredibly, and do not expect this to continue, it never had more than 2 losing trades in a row. Now, boy, that sounds good, right? But there's always a negative to it. I'm going to tell you what the negative is. The downside of this system is it's so selective. It needs 7 factors to line up almost perfectly that it only generates about 3.5 trades per month on 500 stocks. So that's kind of the negative. For an investor, for a trader, yeah, I'll run it on the Russell 1000, 7 trade, So it's more appropriate for traders. I'm just trying to show you how we develop systems and how I develop indicators, which you're going to see. I'm not guessing, 20 period moving average and 40. That's not how I do it. If you're interested in designing your own systems and factors, I seen on the left here, this video should be playing. These are the study, you can get these performance reports from us for nothing. So you can make an informed decision on yourself. We give you all the system parameters, hit ratios, projected returns, population, transaction, entry, exit efficiencies, drawdowns. You can see every single trade. All you need to do is give me your name and email address if you have an interest in designing your own system. At the same time, in the video on the right, again, anyone can prove what we're telling you by a few clicks of the button. If you have the right platform, all you do is say, apply this strategy to 500 stocks, bang, and you generate the same report. You can go in the report and go back into each individual chart and show it for yourself. We're not trying to hide anything here. That's not how I design systems. Lastly, if that sounds like a lot of work, we had the system performance reports and results certified by an independent third-party company called Quantkey, who's a leader in system design, development, appraisals, and evaluation. We backed the analysis. And I will say that it took years. It really is a combined effort. A lot of the MIT group people had a say in this, probably over a couple of decades it took to develop that system, in totality. But it's a good system if you're a trader. The point is that factors exist, right? We know this, there's fundamental factors. Farmer and French proved that. Would price the book, they want to know about price for it, and there's also technical factors. So applying this methodology to evaluate more conventional indicators, I'm going to give you the study results of two of the better performing classic indicators. And just so you know, the results you're going to see are over a 13-year period. And why did I pick this 13-year period? Because the market was flat. I didn't want a market directional bias. Oh, all indicators work when the market's going up, right? So it was flat. And it's going to be on every stock in the S&P 500. And the indicator we're going to look at first is called RSI, the Relative Strength Index. I actually have a book on this. If you take the course and pass my class, you get the book, by the way. And we looked at levels at 20, 80, and 30-70, standard. We buy when it crosses 20 or 30, we sell when it crosses, when it comes back down to 70 and 80. Interestingly, on both testing samples, we got surprising results. First of all, they both made money. The market was zero. So by just using RSI, a simple indicator, you're buying low and selling higher, right? So it did work. But what we found was that in selling this, when RSI entered the overbought area, produced much better results than waiting for RSI to cross back down through. With the wisdom being that when levels got to that high, that overbought, it wasn't good to be greedy, and it took the indicator too long to turn around because the market price dropped so quickly, that you were better off buying at 20 or 30, and then as soon as it got up to the 70, 80, let them get out. Don't wait, don't be greedy, take your profit. As expected, the 2080 level was more profitable. Believe that. It's more profitable and it has like a lot less trades. And that would be the same with all oscillators and all technical formations. The more extremes, the better. That's a general rule. We can prove that quantitatively. Okay? So that's RSI. It clearly aided in stock execution. 2080 was better, but maybe selling when it gets up high, waiting as opposed to waiting a method of return was better. This one's on MACD right here, so that's what I'm going to do. MACD results provided good analysis to two common questions. What MACD settings to use on daily bars and what signals give the best results? And just for the record, I am not, MACD is a very good indicator. I want to say this, if I had to pick one conventional indicator, it would be the indicator I would use most investors. I've written for systems and forecasts. I know Marvin Appel very well. He's endorsed my stuff. I've done shows with him, etc. So I'm not killing this indicator because it's a good indicator. So with MACD, he's actually sat in my shows when I've done this presentation. You were better purchasing only on crosses below the zero line, as you would think, and selling on crosses above the zero line, as opposed to crosses happening everywhere. Best results come with purchases on a MACD setting of 817.9, and then selling on crosses above zero line with the settings of 1226.9. At least that's what my analysis showed, and I did the same thing, the back testing. And this is logical. Now, in this study, MACD gave the highest total returns in isolation of the older, commonly used indicators we tested. But this is a key. Combining the older first-generation indicators will give you much better results. Don't use one in isolation. if you can learn to combine them and which ones combine less, take the course, that will give you a better result. But I'm showing you what we found Mac did. Now, our markets are constantly changing. Just so you know, we only have about 15 minutes left total. Our markets are constantly changing. The good news is this creates a lot of opportunities for us to exploit, as I talked about. The bad news is that many investors continue to try to use investment tools that were developed literally 40 or 50 years ago for a completely different market environment, like when we're using pencils and paper to calculate them. And this is key. Think of OBV. OBV is all or nothing, right? If the stock finishes up a penny or down a penny, it adds and subtracts all the volume. Does that really make sense? It doesn't proportionalize it. Think about shaking accumulation distribution. It doesn't even include overnight movement. Oh my God, are you kidding me? The stock gap's down 50%, finishes up a penny for the day. Shaken says that's positive. Well, I don't know. I just lost 50% of my money. I don't think that's positive. The point is, these indicators were developed a long time ago when we were using pencils and paper. Okay, this is a new indicator called R reversion. Yes, it's my indicator. On the screen, this is a variation of Bollinger Bands, which measures the volatility of an issue and plots standard deviation bands around the price. Bollinger Bands is a good indicator. This indicator, R reversion, does this, but it incorporates the intensity of the move with the amount of the move or the volatility. It combines two factors. So basically what it does is it expands the bands further out, or the boundaries further out, and it contracts them. And this is logical. Ray, I like the stock, I want to get in. Price is dropping to the lower band. Okay, but what if price is dropping to the lower band on huge volume intensity? No, I don't think I want to buy it. Push the band out further. That's what our reversion does. I'm making money. Oh boy, that sell signal's coming. There's huge volume here. The big boys are in. Push the band out further. Okay? It incorporates another thing. It does many different things. It separates up days from down days. Up movements and down movements are different. This creates asymmetrical bands. They're not uniform. They're measuring up and down differently. Blah, 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 blah. This is the funny slide right here. That's just theory, Ray. Show it to us. Table shows the comparative results with various performance metrics between R reversion, Bollinger Bands, stochastics, and RSI, using each indicator's most common buy-sell criteria with their standard parameters of every stock in the S&P 500 at the time of study on a 10-year period, 2014 through 2023. And for just so you know, for our reversion, price goes down, you touch the bottom band, you buy. Price goes up, you touch the top band, you sell. And as you can see, it improved. This is the R reversion, okay? This is Bollinger Bands, stochastics, and R reversion, RSI, and you can see the differences between the two. If it's green, it's red. The bottom line is you can see across every metric by starting to synergize these different practices, instead of measuring one thing, which is all we could do 50 years ago when these were written, you're improving per day trade efficiencies by 34 by over 20% with each one. So I would propose to you that if you're going to use one single indicator, that you would start to use something perhaps slightly more advanced or more customized to today's market environment. And the good news is that this indicator was just accepted by TradeStation. And when I mean just accepted, it will probably be in Monday. And it's now in the base platform. And to put that in perspective, TradeStation hasn't added an indicator into their base platform for, I believe they told me, 11 years. So it's not easy to do. To get an indicator published nowadays, and it has to, you have to prove it's a difference maker, have to go through all types of testing, compliance, etc. It took us about 2 years to get it done. It's already in Metastock. The conviction system that I showed you, the scans, that's already in Metastock. And we have 3 more brokerage firms coming in. So we're pretty proud of getting these in there. Altogether, I have 4 indicators going in, and it's not easy to do. So I think there's validity in some of these tools and indicators. Last section, this is a fun section, it's 8 minutes. You guys made it. We've covered strategies and considerations for making a call, if and sell, when to liquidate. But there's one more viewpoint that I prefer. This is a fun segment. and I base it on a completely different philosophical approach. And it is, do we expel that woman who had her cell phone go off, by the way? Are you guys ready for it? This is the viewpoint that I think most professional traders and the best investors have when approaching the market. It's philosophical, and it's right here. You ready for it? It's bang right there. I want you to consider looking for things that just don't make sense. Right? And I have found that professional traders watch and put more emphasis on things that are not supposed to happen as things that are, and I hope you get something out of this and you can bring it into your way you approach the market. Number one, relative strength, we were talking about earlier. Relative strength on an issue to both the overall market and an issue of industry and sector are huge considerations. Correlation statistics show as much of 80% or more of an issue's movement can now be attributed to the overall market direction for many of the reasons that you see here. If you have a traditionally correlated issue that is declining in an upward market environment when everything else is rising, especially if the sector and the industry is rising also, this is a significant observation that must be factored in before you're saying, oh, that looks like a good value play to me. It takes quite a bit of effort and conviction from the market participants to break an issue from the overall momentum of its peers and against the force of so-called index drag that it's a component of. We just saw this with 3 issues that dropped in the S&P 500 because they were dropped from the S&P 500. You look back and they got killed. People knew that the issues were going to be dropped from the index. Market was going like this and these 3 issues were going like that, and then surprise, oh, we're going to drop these from the index. When we see this, it's a tell. Second one is opposite price movements in relationship to new news and new information. It has to be new. Things like oil went from 110 to $20 a barrel, and an oil refinery just got hit, by a terrorist group or something, and price doesn't drop, and it just stabilized. That doesn't make sense to me. We have a negative earnings release. Boy, they had 2 negative earnings releases, price got killed. We have another negative earnings release, and price doesn't drop at all. It starts to go up. And insiders are buying. This doesn't make sense to me, right? Now, these are the things that, if a negative earnings release price drops, forget it. Somebody backed it in. You can't profit off of it, or it's going to be very hard to. Right? Look for things that don't make sense. I think this is what the best traders and investors do. The last one, of course, is going to be technical. I'm going to touch on this. You can go spend $5, $10, $15, $20,000 on the trading course, and they're going to tell you exactly what I'm going to show you in a few slides. I can't tell you who because I get in trouble for that. But this is what you're going to look for, probably the best trading setups that I know. Unfortunately, other market participants also know the rules of price analysis and what's supposed to happen. And they know where our current or desired orders are likely, and they're going to try to use it against us. We have no friends on Wall Street here, right? Here, what they're going to do is they're going to try to drop prices into areas, into obvious selling zones, whipsaw us out of our current positions, accumulate our shares at lower prices, and then they drive prices back up. Here's the dynamics. It's called the bear trap, and then there's a bull trap, but here's the bear trap right here. We have nice support. Price somehow drops right below and then springs right back up immediately. Now think of the dynamics, what's happening here. New longs are going to jump on this position after seeing the signal, right? Because it's a great trading signal. If you were short this stock and you got short here thinking it was going to go down, you now have to buy the cover when price gets up here, and both forces are driving it up. If you were long this position and got stopped out, now you're mad, you want to get back in, and all these forces stop driving price in a certain direction. Not to mention that some big entity just showed their hand, pulled prices into that area, was trying to accumulate shares, and then drive prices right back up. And I think we have a little story here in the next one. Actually, we don't. This is what a bull trap looks like. We see this a lot. Price looks like it's going to go to new highs. Here it goes. And then a day or two later, it just gaps down 10 to 15% and just starts screaming down at high volume. You've been duped. You got to get out, right? Somebody was trying to sell, give an illusion that prices were going to the moon so they could sell them to you, and then they unloaded everything that they had. Yeah, here's a little story for you, and I'm not making fun of Jim Cramer, he's a brilliant guy, I'm not making here to make fun of anybody, but if you remember a while back, Jim got in trouble, he went on an interview one morning, sounded like he had a couple of, I don't know, he was talking, and he started saying, well, oh yeah, my hedge fund used to do this every morning, and he was bragging about it and laughing about it, he got in trouble for it, by the way. And I can still hear him saying, oh, it's a fun game, he would drive prices lower, accumulate your shares, he knew he had the club, and he just drive them right back up after. So this does exist, I'm not making this up. Okay. Oh my God, we're like our last 3 slides here. I'm gonna conclude this with my quote, big finish, right? And this is called 10 signs that your stock may be in trouble. And this may reference some things that you're familiar with that we haven't talked about, but all in all, I think you get the idea of this. So you're ready, here we go. Number 1, neutral or bearish price action on positive news. We talked about this. This is an important classic tell by the majority of market participants. Something doesn't make sense. Number 2, extremely high or an increasing implied volatility level. This is one of my favorite tells. It's often camouflaged from the issue's price chart. It comes from the derivative market, and that's where they sometimes try to hide what's going on. Number 3, a sudden and relatively high put the call ratio. Again, we're talking options here. I know this is usually interpreted differently, but if somebody's buying a lot of puts, either they're really worried it's going down or they're trying to profit for it to go down, because there's a lot of put activity. That's a concern to me. That makes me want to think I may want to get out. Steadily increasing short interest on a rising stock. Ooh, a stock's going up and somebody keeps nibbling and keeps increasing their short interest. That sounds rotten to me. I may want to take that into consideration. Right here, a new pattern of widespread insider selling. Yes, there's no doubt that insider buying is more relevant. We agree with that. Statistics show that. But boy, if it's widespread and sudden, that makes me, insiders know the most. I want to know what's going on here. I may be able to put my money somewhere else. Number 6 is unexpected and disappointing first earning release. If it's not known why a one-time write-off, earnings releases tend to be like cockroaches, they say. You get one, it's more often that others may follow. So that may be a sign like, hey, I want to take another look at this. A significant surprise reduction in a company's dividend yield. That is not the first way that a company wants to write the ship. If they can do it another way, they will. That's a highly publicized event. They know they're going to get hammered from it by the media and the shareholders. If they're doing that and there's no reason for it, if it's not widespread, you may want to look at it again. A negative relative strength divergence from a major index and industry. We talked about that. That is very, very important. Relative strength in today's markets. No longer attractive fundamentals or stretched valuation. One thing that amazes me with investors is I buy off of fundamentals. You never hear them say they sell off of them, right? They're attractive to buy, but when do they become? Oh no, I love the company. Well, I mean, if you're buying off of them and they really, really get extended and in the upper 1 percentile, maybe you want to consider taking a little off the table, and doing that type of thing, right? And number 10, right here, a bearish technical reversal or continuation price pattern at heart of the technician. Why not use the collective wisdom of all the market participants of what's known and unknown that you just don't know about, but you're going to find out. If you start to see prices turn or formations that are starting to look bad, you may want to take notice on that. A lot of times we don't find out the answers till later. If you want to learn more about the topics that I covered today and about the EI course, you can see the entire itinerary, all of its features, all the certification benefits, and a whole lot more at this website right here. It's right here, www.ai.com/learn. These are all videos. They're all booklets and stuff. You can really learn about the course. If you want a class, please give me your name and email address of the course, Everybody gets a class by going to that site. We end where we begin at the crossroads. Successful investing and creating wealth is possible if you have a strategy and a destination and you avoid a catastrophic crash when en route. I sincerely apologize for all the technical issues that we had at the beginning. Nobody deserves that. My sincerest hope is that you learned something in this presentation that you can use to improve your investment or trading returns. and incorporate it into your style. My name is Ray Rondeau. I'm an investment strategist and senior technical analyst with AAII. And I thank you for your time.